Okay, let's start with a big question. Maybe the big question in financial engineering right now. What's truly the most brilliant piece of financial engineering we've seen?
Hmm, that's a tough one. You've got contenders.
Right. Is it the elegant simplicity, the sheer genius of Jack Bogle's index funds? Built for absolute diversification, lowest possible cost, minimize everything.
The ultimate own the haystack approach.
Exactly.
Yeah.
Or is it the complete opposite? Something like Michael Saylor's latest thing, STRC, which seems engineered for, well, absolute anti-diversification.
Betting the farm, almost literally, on one single asset. And not just any asset, but Bitcoin, famously volatile.
It's a fascinating paradox, isn't it? Two titans, Bogle and Saylor, coming at wealth creation from completely opposite directions.
Completely. But here's the twist. The really interesting part about STRC, the Strategy Inc., preferred stock, it's how it's structured.
Go on.
It somehow takes that wild Bitcoin volatility and transforms it. It engineers it into this steady, rules-based, pretty high-quality stream of dividends. We're talking around 10% annually right now.
Okay, 10% is eye-catching. But the real engineering feat, the thing that makes people sit up and take notice, is the tax treatment, right?
That's the kicker. Currently, that dividend stream is classified as tax-deferred, return of capital.
And we absolutely need to dive deep into what that means. Because, look, if you're in a certain situation, maybe getting closer to retirement, this could be huge.
It's more than huge. It's potentially transformative for financial planning. Think about it. If you're listening and you're, say, a high-income earner, peak earning years.
Paying the top marginal tax rate today.
Exactly. Your whole game might shift toward finding ways, legal ways, obviously, to push that tax liability out, shove it into the future, ideally into retirement years when your income, unless your tax bracket, might be lower.
Or, maybe into those hypothetical future days when AI takes all our high-paying jobs. Just kidding. Mostly.
Huh, maybe. But seriously, deferral in finance isn't just a small benefit, it's power. It enhances compounding dramatically.
And that idea, that powerful tax deferral, combined with, let's be honest, the pretty painful performance of traditional bonds lately.
Yeah, that's the other side of this coin.
It leads us right here to what we want to tackle today. Two main things on our agenda.
Lay it out.
First, we got to challenge the old standard, the boring, maybe sacred 60-40 portfolio.
60% bonds, 40% stocks, the bedrock for decades.
But has it worked? We need to be real. That bond side, the 60%, it just hasn't delivered stability the way it was supposed to over the last, decade? Especially when rates started rising.
It's a fair criticism. It failed that stress test.
Okay, so that's point one. Point two is digging into this alternative philosophy. We're calling it the modern mix.
A portfolio construction that tries to face today's realities.
Exactly. It has to account for, two massive trends Jack Bogle didn't really face in the same way. One, the arrival and likely permanence of digital assets, like Bitcoin. It's not going away.
Agree. And the second trend.
Central banks, globally, they're actively buying gold again, stacking it up.
It's a fascinating shift. They're not exactly ditching the dollar overnight.
No, nowhere near. But they are buying that yellow rock. And that tells you something, right? It fundamentally changes how you might think about true diversification. Diversification against what? Maybe against challenges to the whole fiat system.
It definitely makes you question if just holding U.S. bonds is the ultimate safe haven anymore. If central banks themselves are hedging, maybe you should too.
It's a complex picture, and we're really glad you're joining us to unpack it all in this deep dive. Seriously, the response we get from you all is amazing. It really keeps us going, digging into these details.
It really does. And speaking of responses, here's a fun fact, maybe a bit of a paradox for us. Statistically, only about, 2%?
Yeah, about 2% of you, our listeners who tune in every time, are actually subscribed right now.
Which is kind of wild, right? Considering the level of detail we're about to get into on, corporate finance and tax law.
Exactly. Which leads us perfectly into our own little financial engineering challenge here at the show.
Uh-oh. What are we engineering now?
Growth. Our brilliant and, let's say, persistent marketing team has a clear plan. We need video versions of these deep dives. That's how you reach more people, get more subscribers these days.
Makes sense, but video production?
Yeah.
That sounds expensive. Or complicated.
It can be. Which brings us to the classic chicken and egg problem. We want top quality video, but without, hiring a Hollywood crew.
Okay, what's the plan?
We've been looking very closely at a tool called Mosaic AI. You can check them out. It's mosaic.s.
Okay, AI video editing.
Yeah, it's pretty incredible stuff. Cutting edge, it basically automates a huge chunk of the creative process. You feed it the audio, like our deep dive link, and it can generate visuals, automate editing, make it look amazing without us needing a whole studio.
Sounds useful. But I sense a but coming.
There's always a but. These advanced tools cost money. To unlock the funds to really justify using Mosaic consistently for every deep dive, we need to hit a target.
A subscriber target?
Yep. We need to reach 1,000 subscribers. That's the number our marketing wizards say unlocks the budget for the fancy AI tools.
Ah, the chicken and egg. Need subscribers to get the tool to get more subscribers.
You got it. So, here's the ask. If you like what we do, if you find value in this deep dive format, please do two things. First, hit that subscribe button. It literally takes a second. Second, share the show. Tell your friends, your colleagues, share it in your WhatsApp groups, whatever network you use.
Help us get to that 1K mark.
Yeah.
You can consider yourselves our seed investors, or maybe our senior preferred shareholders in this growth plan.
Perfect analogy to kick things off. Let's get into the structure of these portfolios then. The Bogle legacy versus this new challenger.
Let's do it.
Okay, let's lay the groundwork.
Right.
We have to start with Jack Bogle. He's more than just an investor, right? He's like a philosophical force in modern finance. Why is his approach still the absolute foundation for millions of retirement plans?
It really is. And Bogle's genius, I think, was in its radical simplicity. He looked at the investment world, particularly actively managed mutual funds back then, and just crunched the numbers for decades.
And his big takeaway?
It wasn't about picking the winning stocks. It wasn't even market timing. The single biggest enemy, the biggest drag on investor, returns over the long haul. Costs. Simple as that.
Fees, trading expenses, turnover, all that stuff just eats away at your money.
Exactly. It's like friction. It just slowly, relentlessly erodes the power of compounding. So his conclusion was profound. Minimize that friction.
Which led him to found the Vanguard Group. And that structure was unique too, wasn't it? Owned by the funds themselves.
Right. Owned by its investors, essentially, which aligned incentives perfectly. And then he introduced the killer app, the low-cost index fund. Just buy the whole market, do it dirt cheap, and hold on.
And he proved, mathematically really, that this approach would beat most active managers over time, simply because you kept more of your money working for you.
Precisely. Which brings us to the portfolio that became almost like gospel for so many. The classic 60-40.
60% bonds, 40% stocks, usually represented by something like VTI for stocks and BND for bonds.
That's the standard Boglehead core. 40% VTI for that broad market growth engine, and 60% BND, the bond component, meant to be the ballast, the stability, the income generator, the thing that zigs when stocks sag.
Okay, but here's the rub. Here's why we're even having this conversation. That 60% bond allocation, the BND part, it arguably hasn't done its job recently. Why did that supposedly stable part fail us?
That's the crux of it, isn't it? The pain point. When inflation kicked up and the Fed started hiking interest rates aggressively, bonds behaved differently than expected.
How so?
Well, fundamentally, bond prices move inversely to interest rates. When new bonds are issued with higher yields because rates are up, the older bonds with lower yields, like the ones held at BND, become less attractive.
So their price drops.
The price drops. And BND holds thousands of these bonds. What investors experienced was something called duration risk.
Duration risk. Can you unpack that a bit?
Sure. Duration is basically a measure of how sensitive a bond's price is to changes in interest rates. The index BND tracks, the AG, has a certain average duration. When rates moved up sharply, that sensitivity translated directly into price declines, losses on the principal.
So the very thing meant to cushion the portfolio when stocks fell actually fell too because of rising rates.
In many recent periods, yes. That negative correlation, the zigzag effect, it broke down. Bonds became correlated with rising rates, which hurt their prices. The stability wasn't there when people expected it. They found they had price risk they maybe didn't fully appreciate.
Okay, so the traditional ballast got leaky. That makes the case for looking elsewhere, which is the whole idea behind the modern mix.
Exactly. The modern mix basically says, okay, if BND isn't the reliable anchor it used to be, what else can provide stability or a different kind of hedge?
And the proposed structure is what, 40% VTI still?
Yep. Keep the broad stock market engine, but then replace the 60% BND with a split. 30% GLD, which is gold.
The classic inflation hedge.
Right. And the other 30% in STRC, that's Strategy Inc., preferred stock we talked about.
So you're swapping out diversified government-heavy bond exposure for physical gold and a single company's preferred stock linked to Bitcoin.
That's the core substitution.
Yeah.
It's a very different philosophy of what constitutes the portfolio's ballast or hedge. One focuses on credit quality and diversification, the other on monetary hedges and concentrated engineered income.
Okay, this is a fundamental shift. Let's get into the nitty-gritty of what these four things actually are. VTI, BND, GLD, and STRC.
Sounds good. Understanding the mechanics is crucial.
All right, let's start with the part both portfolios agree on. VTI, the engine of growth. It's 40% in both the Boglehead and modern mix. What exactly are you getting with VTI?
VTI is Vanguard's total stock market ETF, and total is the key word here. Its goal is to give you exposure to basically the entire investable U.S. stock market.
So not just the big guys like the S&P 500.
Nope. It goes way broader. It tracks an index called the CRSP U.S. Total Market Index. Think over 3,500 companies. Large cap, mid cap, small cap. It's all in there.
So if you want a piece of the whole American economy, from Apple down to some tiny tech firm, VTI aims to capture that. It's like the ultimate diversification within U.S. stocks.
That's the idea. Maximum breadth. And sticking to Bogle's principles, it does it incredibly cheaply. The expense ratio is tiny, like 0.03%.
3 basis points, almost free. So it's pure, cheap, broad exposure to U.S. economic growth. Hard to argue with that component.
Right. It's the least controversial part of either strategy.
Okay, now let's look at the piece getting challenged. BND, the ballast of stability. This is the big 60% chunk in the traditional Boglehead setup.
BND is Vanguard's total bond market ETF. Its job is supposed to be low volatility, stability, and generating a predictable stream of income from interest payments.
And what does it hold?
It tracks that index we mentioned, the Bloomberg U.S. Aggregate Float Adjusted Index, often just called the AG. This is the benchmark for pretty much the entire investment-grade bond market in the U.S.
Investment grade meaning relatively safe stuff.
Generally, yes. Think U.S. Treasuries, high-quality corporate bonds, mortgage-backed securities issued by government agencies. It's incredibly diversified across issuers, holding something like 17,000 different bonds.
Wow, 17,000. So the risk of any single company defaulting and hurting the fund is negligible.
Extremely low. The main risk, as we discussed, turned out to be interest rate risk or duration risk.
And its primary role in the 60-40 was what again?
Non-correlation to stocks. Historically, when VTI went down, BND was expected to hold steady or even go up, cushioning the blow to the overall portfolio. It was the safety net.
And like VTI, super low cost.
Yep, same 0.03% expense ratio, Vanguard's trademark. But again, that historical non-correlation faltered recently, which is why the modern mix looks elsewhere.
Okay, let's look at those replacements. First up, GLD, the inflation hedge. This takes up 30% in the modern mix. What is GLD?
GLD is the SPDR Gold Shares ETF. It's one of the largest, most liquid ways to get exposure to gold. Structurally, it's pretty simple. It's an ETF that actually holds physical gold bullion.
Real gold bars sitting in vaults somewhere.
Essentially, yes. Held in allocated accounts, mostly in London vaults, on behalf of the ETF shareholders.
Now, gold is different from stocks or bonds, right?
All right.
It doesn't do anything.
That's the key philosophical point. Gold is a non-productive asset. It doesn't generate earnings, it doesn't pay dividends, it doesn't pay interest. Its entire return comes from one thing: the price of gold going up or down.
So why on earth would a portfolio designed for, say, retirement allocate a whole 30% to something that doesn't produce anything? Seems counterintuitive.
It does, from a traditional perspective. Its role in the modern mix is purely as a macro hedge. It's there specifically to protect against systemic risks, primarily sustained high inflation, and the potential for long-term debasement of fiat currencies, like the dollar.
The argument being that when faith in government money or debt waivers, people historically turn to gold as the ultimate non-sovereign store of value, something outside the system.
Exactly. It's seen as a hedge against monetary policy mistakes or instability. That 30% allocation is quite high, reflecting a belief, perhaps, that those monetary risks are more significant today than they might have been in Bogle's prime. It's a bet on macro safety over traditional diversification.
Okay, makes sense as a rationale. Now, the really unique piece, STRC, the income substitute, the other 30% in the modern mix. This one's more complex. What exactly is STRC?
Right, STRC needs a bit more unpacking. Its official name is the Variable Rate Series, a perpetual stretch preferred stock. It's issued by Strategy Inc. You probably know them better by their old name, MicroStrategy, or their ticker, MSTR.
Okay, preferred stock. So it's not common stock like MSTR, and it's not a bond. It's somewhere in between.
Precisely. It has features of both. Its economic value is undeniably tied to Strategy Inc.'s main asset, which is their massive holding of Bitcoin in their corporate treasury.
So its value is linked to Bitcoin ultimately.
Fundamentally, yes. Although the company still has a software business, it's largely seen as a publicly traded way to get Bitcoin exposure. But STRC itself is structured as preferred equity.
And what does preferred mean in practice?
It means it has priority over common stock. Holders get paid dividends before common stockholders do. And, crucially, in a bankruptcy or liquidation scenario, preferred holders get paid back their principal before common stockholders see a dime.
So they sit higher up in the capital structure, less risky than owning MSTR common stock.
Significantly less risky from a structural standpoint. MSTR common stock is way down at the bottom, absorbing the first losses. STRC has a priority claim. It also trades much more like a bond because it's designed to pay out that regular high dividend we mentioned.
Right, the 10% dividend. So that's the core appeal. It replaces the income you might have expected from B&D, but potentially much higher.
That's part of it. High yield combined with that structural seniority. But the other part of the appeal, the real hook, is that current tax treatment, that tax-deferred return of capital ROC classification.
High yield, structurally senior, and tax deferred for now. Okay, I can see why that's tempting, especially compared to B&D's recent performance.
It ticks a lot of boxes, especially for investors focused on tax-efficient income accumulation. It's a very specific piece of financial engineering. #3, the quantitative temptation and tax engineering.
All right, we've defined the pieces. Now let's see how they stack up. You ran a simulation, right? A 10-year performance showdown from roughly 2015 to 2025. How does the traditional Boglehead mix compare to this modern mix on paper?
Yeah, simulations are always backward-looking, of course, but they help illustrate the why. Why would someone even consider the modern mix? We used historical annualized returns for VTI, BND, and GLD over that period.
And what were those numbers, roughly?
VTI did very well, around 14.7% annualized. GLD provided a decent return, about 7.9%. But BND, that was the drag, only about 1.9% annualized.
Ouch, only 1.9% from the 60% allocation. That hurts. And for STRC, since it didn't exist for the whole period, what did you assume?
We used a conservative 10.0% annualized return based on its target yield structure. As we mentioned, its actual rate has recently been even higher, like 10.50%, but 10% felt like a fair, stable assumption for the simulation.
Okay, so starting with the $1,000, reinvesting everything for 10 years, how did the Boglehead 60-40, actually 40-60 here, 40 VTI, 60 BND perform?
All right, crunching those numbers. The 40% VTI at 14.7% and 60% BND at 1.9% gives you an average annual return for the whole portfolio of about 7.02%.
Okay, 7.02% average. Not terrible, but not amazing either. What does that $1,000 grow to?
After 10 years of compounding at 7.02%, that initial $1,000 investment ends up being worth approximately $8,970.
Almost doubled your money. Steady, low cost, exactly what Bogle promised, though maybe lower returns than hoped due to the BND drag. Now the comparison. How did the modern mix 40 VTI 30 GLD 30 STRC fare in the same simulation?
Okay, so 40% VTI at 14.7%, 30% GLD at 7.9%, and 30% TRC at our assumed 10.0%. You blend those together, and the average annual return jumps significantly. It comes out to approximately 11.25%.
Whoa, okay. 11.25% versus 7.02%. That's a big difference. What does the $1,000 grow to in this case?
Compounding at 11.25% for 10 years turns that $1,000 into approximately $2,913.
Okay, let's pause there. $1,907 for the Boglehead mix, $2,913 for the modern mix. That's almost $1,000 more on just a $1,000 investment. Nearly 50% more wealth generated in this specific simulation.
That's the quantitative temptation right there. Yeah. That delta, that potential for significantly higher wealth accumulation, is the core reason someone might challenge the Boglehead orthodoxy and accept the different risks of the modern mix.
It starkly shows the opportunity cost, in this period at least, of holding those low-yielding bonds in an environment where stocks and alternatives did well.
It does, but, and this is crucial, those superior returns in the simulation hinge entirely on STRC behaving as designed, delivering that stable high income.
Right, so how does it actually achieve that stability, especially when its underlying value driver, Bitcoin, is so notoriously volatile? Let's dig into the STRC dividend mechanism and stability.
It's actually quite clever, a real piece of financial engineering. The key is that the dividend rate isn't fixed forever. It's variable, and it adjusts based on a preset, rules-based framework.
Rules-based. So management isn't just deciding the rate each quarter.
No, not directly. The whole mechanism is designed, quote, to strip away price volatility from the preferred stock itself. It works by adjusting the dividend rate monthly. And the sole goal of that adjustment is to keep the trading price of STRC hovering right around its $100 par value.
Huh. So if the price starts to drop, say, because of market jitters or a dip in Bitcoin, the rules dictate the dividend yield has to go up to attract buyers back and push the price back towards $100.
Exactly. The prospectus lays out the framework. For instance, if STRC trades between $95 and $98.99 for a certain period, the framework recommends bumping the dividend rate up by 25 basis points, or 0.25%.
And if it drops even further, below $95.
The recommendation is often steeper, maybe a 50 basis point increase. It's designed to automatically increase the yield to compensate for perceived risk or market pressure, thereby stabilizing the price near par.
So it acts like an automatic stabilizer for the STRC price itself, even if the MSTR common stock is going wild.
That's the design.
Yeah.
And we saw it play out recently, remember, after the Q3 2025 earnings call for Strategy Inc.
Vaguely. What happened?
Well, MSTR common stock took a dive. The market looked past the big headline net income number, realized it was mostly non-cash accounting gains from Bitcoin going up.
Ah, the fair value accounting.
Right. And they've focused on the fact that the actual underlying software business saw a pretty sharp decline in support revenue, like 16% year over year. That's bad news for common stockholders.
So MSTR dropped, but what about STRC?
STRC did exactly what it was supposed to do. It barely budged. It closed stably around $99.38 that day, and the company confirmed the dividend rate was ticking up for the next month to 10.50% following the rules.
Wow. So the mechanism worked. MSTR absorbed the volatility shock, STRC adjusted its yield and maintained price stability.
Precisely as engineered. The common stock takes the equity risk. The preferred stock aims for bond-like price stability through yield adjustments.
Okay, that explains the stability part. Now, let's get to arguably the most powerful piece for many potential investors, the tax-deferred ROC advantage. Explain return of capital again, simply.
Sure. Return of capital, ROC, is a specific tax classification for a distribution from a company to its shareholders. Instead of being treated as taxable income, like a normal dividend from profits, it's treated as the company giving you back a portion of your original investment principal.
Giving me my own money back, essentially.
From a tax perspective, yes. And the immediate impact is huge.
No immediate taxes?
Generally, no. That ROC distribution you receive is not taxed as income in the year you receive it. Instead, the IRS requires you to reduce your adjusted cost basis in the investment by the amount of the ROC distribution.
Okay, reduce my cost basis. What does that mean in the long term?
It means you defer the tax liability.
Okay.
You'll eventually pay tax, but only when you sell the security. Because you've been reducing your cost basis all along, your calculated capital gain when you sell will be higher than it otherwise would have been.
Ah, I see. So if I buy STRC for $100 and over a year I get $10 in ROC distributions, my cost basis drops to $90. If I then sell it for $100, I have a $10 capital gain, even though the price didn't change.
Exactly. You've effectively converted what would have been immediately taxable ordinary income, the 10% yield, into a deferred capital gain, which is often taxed at lower rates anyway and only payable years down the road.
For a high-income earner paying, say, 37% federal plus state taxes on ordinary income, this is massive. They get the 10% cash flow now, pay 0% tax on it now, and potentially pay maybe 20% capital gains tax way off in the future.
The power of tax deferral is immense, especially over long periods. It allows 100% of that yield to stay invested and compound, rather than having 30–40% skimmed off the top by taxes each year, like you'd have with typical corporate bond interest.
It's like creating your own private tax advantage compounding machine outside the limits of a 401k or IRA.
That's a good way to think about it. But how can Strategy Inc. legally classify these hefty distributions as ROC, especially when they're sitting on billions in unrealized Bitcoin gains? It all comes down to a specific part of the U.S. tax code, right?
Yes, it hinges entirely on a concept called earnings and profits, or E&P.
E&P, not the same as accounting profit. No, it's a specific tax accounting measure. Basically, under U.S. tax law, a distribution only counts as a taxable dividend to the extent the company has positive tax E&P, either current or accumulated.
And Strategy Inc.'s position is they don't have positive E&P.
Correct. They maintain that their tax E&P is negative, and they project it will remain negative for, quote, 10 years or more.
How is that possible with all that Bitcoin appreciation?
Because those Bitcoin gains are unrealized for tax purposes as long as they don't sell. They haven't triggered a taxable event on the bulk of their holdings.
Ah, the never sell Bitcoin engine. That's the key.
That's a huge part of it. Plus, they likely have other tax deductions, maybe accelerated depreciation on assets, interest expenses on their debt that offset any taxable income generated by their software business. helping keep that overall tax EMP calculation negative.
So as long as they keep holding Bitcoin and manage their other tax items effectively, the distributions legally qualify as non-taxable ROC.
That's the mechanism driving the tax benefit. It's clever, but it puts a significant burden back on the investor, a burden that traditional Bogleheads actively seek to avoid.
You mean tracking everything?
Precisely. This isn't passive investing anymore, not fully. Your broker will send you a Form 1099 DIV at year-end, and Box 3 will show the amount of non-dividend distributions, the ROC amount. That part's easy.
But that's not enough.
No. The crucial step, the one that requires diligence, is that you, the investor, must manually track and adjust your cost basis for every single ROC distribution received.
So every time you get that $10 payout we talked about, you have to go into your records and subtract $10 from your initial purchase price for that block of shares.
Yes. If you hold STRC for, say, 10 years, and you fail to do this meticulously when you finally sell, your reported cost basis will be way too high. You'll underreport your capital gain.
And the IRS will likely catch that eventually, leading to back taxes, penalties, interest, a mess.
A big mess. It requires diligent record keeping. So while the tax deferral is incredibly attractive, the need for this active manual tracking definitely moves the modern mix away from the pure set-it-and-forget-it simplicity that is the hallmark of the Boglehead philosophy. Bogle wanted elegance. STRT demands spreadsheets.
A really important distinction. Okay, we see the upside, higher simulated returns, tax efficiency. But what are the real risks? How would a Bogle purist push back?
Oh, they'd push back hard.
Yeah.
And it centers on safety.
We've laid out the case for the modern mix, the performance, the tax angle. But the Boglehead philosophy wasn't built on maximizing returns at all costs. It was built on safety, predictability, avoiding catastrophe. How does that viewpoint clash with this modern mix?
Fundamentally, the Boglehead counterargument boils down to structural safety first. Their primary and probably insurmountable objection to including STRC is the acceptance of single-issuer credit risk.
Meaning, you're betting on one specific company, Strategy Inc., not going bankrupt.
Exactly. BND, holding thousands of bonds, heavily weighted to the U.S. government, essentially eliminates that specific risk. If one company in the ag defaults, it's a tiny ripple. If Strategy Inc. faces serious trouble.
Your 30% STRC allocation could be severely impaired or even wiped out.
That's the nightmare scenario for a Boglehead. And they also argue that the very thing the modern mix touts, that high fixed-like dividend from STRC, isn't just a feature, it's a potential risk accelerator.
How so?
That roughly $640 million annual dividend payment STRC requires, that's a huge fixed cash outflow for the company. It's a contractual obligation. In a severe downturn, say a prolonged Bitcoin bear market, that massive fixed cost doesn't shrink. It becomes an anchor that accelerates the burn through the company's resources, increasing the risk to the principal of STRC itself.
So Bogle's choice is clear. Accept the risk of underperformance making less money, like we saw with BND in the simulation, rather than accepting the risk of total capital loss from a concentrated bet on a single issuer like STRC.
That's the classic Boglehead trade-off. Safety and diversification over concentration and potentially higher but riskier returns.
What about the other part of the modern mix ballast, the 30% in gold, GLD? Would Bogle have been okay with that?
Likely not at 30%. Remember, his core principle for the ballast was stability and, ideally, income generation. Gold is unproductive. It pays nothing.
And it can be pretty volatile itself in the short term.
Very volatile. It doesn't provide the kind of predictable low volatility counterbalance to stocks that investment-grade bonds traditionally did. Bogle might concede a very small allocation, maybe 5%, perhaps 10% of the absolute maximum as sort of deep crisis hedge, but 30%. Yeah. Way too much concentration in an asset that relies purely on price appreciation and has no yield.
Okay, so Bogle rejects STRC on credit risk and rejects a heavy gold allocation as unproductive and volatile. But the proponents of the modern mix would argue the world has changed, necessitating the macro case for gold, GLD.
Right. This directly challenges the Boglehead assumption that the U.S. economy and U.S. treasuries are this singular, unassailable safe haven. The argument centers on trends like de-dollarization.
The idea that other countries are actively looking to reduce their reliance on the U.S. dollar.
And diversifying their reserves. The most visible sign of this is the significant sustained buying of physical gold by central banks around the world. China, Russia, India, Turkey, many others.
What signal does that send?
It signals, at minimum, a growing institutional skepticism about the long-term purchasing power of the dollar and the ultimate safety of holding massive amounts of U.S. Treasury debt, especially in an era of high U.S. debt levels and geopolitical friction.
They're essentially hedging their own bets against the world's reserve currency, casting doubt on assets like BND or even inflation-protected treasuries, to DPS, as being sufficient protection against sustained inflation or monetary mismanagement.
Precisely. So from this macro perspective, gold isn't just a volatile commodity. It's playing its ancient role as a hedge against monetary risk, against currency debasement. It's the ultimate non-sovereign store of value when trust in sovereign promises falters. The modern mix argues that this macro safety is now paramount, perhaps even more important than the traditional structural safety offered by BND.
So it's a trade-off. Accept the credit risk of STRC and the unproductiveness of GLD to gain a hedge against deeper systemic monetary risks.
That's the philosophical choice. Now let's dive deeper into STRC's specific safety features because there's a confusing point here.
The collateralized versus not collateralized issue.
It's exactly. Company marketing often implies STRC is backed by hard collateral, meaning the Bitcoin. But if you read the legal filings, the prospectus, it clearly states the preferred stock is not collateralized. How do we square that circle?
Yeah, that sounds contradictory.
It requires understanding the nuances. Legally speaking, STRC is unsecured. Holders don't have a specific legal claim, a lien, on any particular Bitcoin in the company's treasury. If the company defaulted, STRC holders can't just go seize a pile of Bitcoin.
Okay, so legally unsecured,
But it is absolutely economically backed by the company's assets. Strategy Inc. is its Bitcoin treasury. As of Q3 2025, we're talking over $70 billion in assets, almost all of it Bitcoin. That's the pool of value supporting all the company's obligations.
And more importantly, you said it's structurally secured.
Yes, by its position in the capital structure. That liquidation waterfall we talked about, it gets paid before common stock. That structural priority is a powerful form of security, even without a direct legal lien.
Okay, this brings us to the stress test. Michael Saylor himself has claimed STRC principal is safe even if Bitcoin crashes by 80%. Can we actually verify that using their recent financials?
We can model it out. Let's take their Q3 2025 structure as a snapshot. Assume Bitcoin was trading around, say, $111,750 just for round numbers. An 80% crash takes the price down to $22,350 per Bitcoin.
That's a brutal crash, almost unimaginable for many holders today. What does that do to Strategy's total asset value?
Based on their reported Bitcoin holdings, that 80% drop would slash their total assets down to about $14.32 billion.
Okay, $14.3 billion left. Now run the waterfall. Who gets paid first in a liquidation?
Tier 1 is always the most senior debt. Strategy has about $8.24 billion in senior convertible notes. They get paid first, in full.
Leaving how much?
That leaves about $6.28 billion in remaining asset value for the equity holders below the debt.
Okay, next in line, the preferred stock stack.
Right. The most senior preferred is actually another series, STRF, with about $1.26 billion outstanding. They get paid next, also in full. $4.82 billion remaining. Now comes STRC. The total claim for STRC principal is about $2.8 billion.
And with $4.82 billion available.
STRC gets paid 100% of its principal back. Even in this catastrophic 80% Bitcoin crash scenario, STRC holders recover their full investment according to this model.
So Saylor's claim holds up based on these numbers. What protects STRC?
It's protected by the layers of capital below it in the waterfall. There's another couple billion, about $2.64 billion, and even more junior preferred stock, STRK and STRD. And then, of course, all the common stock equity, MSTR. All of that gets wiped out entirely before STRC takes a single dollar of principal loss. They act as a massive buffer.
That's pretty significant protection, and your analysis actually showed the 80% figure was conservative, right? You calculated the actual point where STRC principal starts to get impaired.
Yes. Based on that Q3 2025 structure, STRC principal only begins to suffer losses if Bitcoin crashes by 82.8%. That corresponds to a Bitcoin price of around $19,200. At that point, the assets are just barely enough to cover all the debt and all the preferred stock down to STRC's level.
And the point where the whole company becomes insolvent assets can't even cover the debt.
That requires an even deeper crash, 88.5% drawdown, taking Bitcoin down to about $12,859. So the structural protections are mathematically robust against even very severe downturns. Saylor's 80% claim gives a comfortable margin above the actual impairment point for STRC.
Okay, that provides some comfort regarding liquidation risk. But liquidation is the worst-case scenario. What about the day-to-day operational reality? This brings us to the solvency dilemma. How does the company actually pay that massive $640 million annual dividend bill when their reported cash on hand is often quite low, like $54 million?
This is the constant, the operational tightrope they walk. That $640 million is a huge fixed USD obligation that comes due regularly. They clearly don't generate that much cash from their software business.
So where does the cash come from?
Their primary mechanism, as stated in their filings and calls, is to continuously issue new shares of their common stock, MSTR, into the market through at-the-market ATM programs. They sell new MSTR shares to raise the cash needed to pay the dividends on STRC and service their debt.
Wow. So they're essentially funding payments to existing preferred and debt holders by diluting the existing common stockholders.
That's the model, and it works fine as long as the price of MSTR common stock stays high enough and the market has appetite to absorb those new shares.
But that model seems incredibly vulnerable. What happens if Bitcoin's price drops significantly, dragging MSTR's price down with it? Wouldn't the market's willingness to buy new MSTR shares just evaporate?
That's the critical vulnerability. If the MSTR price tanks or if market liquidity dries up, the ATM program could fail. They wouldn't be able to raise enough cash by selling new stock.
And if that financing route closes, what then? This leads to the last failsafe, right? The fine print in the risk disclosures.
Exactly. If other financing options fail, the company explicitly states in its SEC filings that it may be required to sell Bitcoin from its treasury to meet its financial obligations, including those STRC dividend payments.
Hold on, sell Bitcoin. Doesn't that completely undermine the entire never sell philosophy that enables the ROC tax treatment in the first place? If they're forced to sell, doesn't the whole house of cards potentially collapse?
You've hit the absolute core contradiction. That forced sale is the ultimate real fail-safe. And yes, it directly conflicts with the never sell narrative that underpins the long-term viability of the ROC tax advantage. It's the break glass in case of emergency option.
But isn't there another, less obvious risk if they are forced to sell in a crash scenario? Something about taxes.
Yes, and it's potentially catastrophic. It's the risk of a taxable death spiral.
Okay, explain the death spiral.
Remember, the IRS treats Bitcoin as property. Selling it triggers a taxable capital gain or loss. Strategy Inc.'s average cost basis for its Bitcoin, it's quite high, let's say around $74,000 based on recent reports.
Yeah.
Now, imagine they're forced to sell Bitcoin during that 80% crash scenario we modeled, when the price is down at $22,350 just to raise cash for an STRC dividend payment.
They'd be selling way below their cost basis.
Massively below. They would realize a huge capital loss for tax purposes, over $51,000 loss per Bitcoin sold. 74K basis, 22K sale price.
So realizing those massive losses crystallizes them on the balance sheet.
Yes, it hammers the company's book value, makes their financial health look even worse, which in turn makes it even harder to raise any remaining capital through the ATM program because investor confidence plunges.
And could realizing huge capital losses actually flip their tax E&P calculation?
Potentially, depending on the scale and other factors.
Yeah.
If the forced selling is large enough or sustained enough, it could certainly impact the E&P calculation. If E&P turned positive, the ROC designation for STRC dividends would end. They'd become taxable dividends.
Which would destroy a key part of STRC's appeal, likely causing its price to fall, requiring even higher dividend rates.
Exactly. Leading to more pressure to sell Bitcoin, realizing more losses. It could become a self-reinforcing downward spiral. The entire financial structure, relying on continuous equity issuance via the ATM, is designed precisely to avoid ever having to trigger that first forced sale and risk igniting this potential death spiral.
Wow. Okay, so the structural protection in liquidation is strong, but the operational solvency relies on a potentially fragile funding mechanism that could unravel badly if Bitcoin takes a sustained, deep hit.
That's the tightrope. #V, risk transfer and final implications.
Okay, it seems crystal clear now that STRC's stability, its bond-like behavior, isn't magic. It's achieved by actively transferring risk somewhere else.
Absolutely. The risk doesn't disappear, it gets concentrated. And it gets concentrated primarily onto the common stockholders, the holders of MSTR.
This really clarifies that MSTR leverage call option analogy. Can you walk us through that again? How does the whole structure function like an option?
It's a fantastic way to understand Strategy Inc.'s capital structure. Think of it as a classic example of risk tranching. They've sliced the company's overall risk profile into different layers, or tranches.
With STRC being a senior tranche.
Exactly. STRC and STRF above it, and the debt above that, are the senior tranches. They're designed for relative stability, predictable income, and they have first claim on the assets and cash flows. They get paid first.
And MSTR common stock is the junior tranche, the bottom layer.
Precisely. MSTR is the equity tranche, the most junior layer. It's designed to absorb the first losses, but also to capture the residual upside. It is inherently the riskiest part of the capital structure, designed for maximum leverage to the underlying asset, Bitcoin.
MSTR holders are the ultimate shock absorbers. They only get what's left after everyone else above them is satisfied.
Correct. And the key element that creates the option-like behavior is that massive fixed financial obligation. We keep mentioning the roughly $640 million per year needed to pay interest on the debt and dividends on all of the preferred stock, STRF, STRC, etc.
That fixed payment acts like the strike price of the option.
Exactly. Think of it as the hurdle the company's value, driven by Bitcoin, needs to overcome each year.
So scenario one, Bitcoin skyrockets. The company's asset value balloons to, say, $100 billion, $150 billion.
In that case, the $640 million fixed strike price payment becomes almost trivial in comparison. It's a tiny fraction of the total value.
And who gets all that massive remaining value?
The MSTR common stockholders. Because they are the residual claimants, they capture virtually 100% of that enormous upside above the fixed strike price. The leverage is immense. It performs exactly like a deeply in-the-money call option on Bitcoin.
Okay, that's the upside. Now, scenario two, Bitcoin crashes hard, like in our stress test. The asset value plummets.
The company still owes that fixed $640 million strike price payment. That obligation doesn't go away.
And because MSTR is at the bottom of the waterfall.
That fixed cost eats directly into the common equity value first. The losses for MSTR holders are magnified downwards, again because of that fixed payment hurdle. It behaves exactly like an out-of-the-money call option that could potentially expire worthless, or at least be severely underwater.
So the very structure that gives STRC its stability and high yield, the fixed dividend, the seniority is precisely what turns MSTR common stock into this hyper-leveraged, highly volatile Bitcoin proxy.
You've nailed it. STRC's engineered stability is achieved by concentrating and magnifying the inherent Bitcoin risk onto the MSTR common shares. It's a deliberate transfer of risk within the capital structure.
Which brings us finally to the conclusion of the challenge. We've dissected both approaches. The listener is left facing a really fundamental choice, isn't it? It's not just about numbers, it's about philosophy.
It really is. You have two distinct paths, each with its own definition of risk and safety.
Path one, the traditional Boglehead way. You choose structural safety. You prioritize ultra-low cost, extreme diversification through things like VTI and BND, and predictable, albeit potentially lower, compounding.
And in choosing that path, you explicitly accept the risk of underperformance, especially relative to newer asset classes or during periods where traditional bonds lag significantly, like we saw in the simulation.
Yeah.
You prioritize avoiding catastrophic loss over maximizing potential gains.
Path two, the modern mix. You're chasing those superior simulated returns. You're embracing macro safety by hedging against potential dollar debasement and monetary risks with significant allocations to gold and a Bitcoin proxy like STRC.
And it's a huge but. You must accept the trade-offs. You take on highly concentrated single-issuer credit risk with STRC. You accept the volatility and unproductiveness of a large gold allocation. You take on the active management burden of tracking ROC and cost basis meticulously.
The potential for greater wealth accumulation is there, quantitatively, but the cost is complexity and a type of concentrated risk that Jack Bogle spent his entire career warning investors to avoid at all costs.
It truly is the investor's dilemma for our current era. Structural safety versus macro safety. Simplicity versus engineered complexity. Diversification versus concentration. There's no single right answer for everyone.
A really profound set of trade-offs to consider. #outshag_outro. Okay, before we wrap up this deep dive, we want to leave you with a couple of final thoughts to chew on. Things that build on this whole philosophical clash we've explored.
Yeah, the first one is sort of a historical what if. If Jack Bogle were still with us today looking at the current landscape, how would he view Bitcoin?
Right. Would he see it purely as speculation? A volatile, non-productive asset like tulip bulbs, completely outside his framework, stick rigidly to his guns on bonds being the only true ballast?
Or would he look at the structural issues we discussed? Central banks buying gold, the recent failures of bonds to provide non-correlation, the sheer scale of global debt, the challenges to dollar dominance.
Would he acknowledge that perhaps the nature of risk has changed? That maybe a true non-sovereign store of value has a place, even for a conservative investor? And if so, how would he have cautiously, pragmatically tweaked his beloved 60-40? Would he have carved out maybe 1%, 2% for a diversified basket of digital assets?
It's a fascinating question for anyone thinking about long-term portfolio construction today.
Mm,
How would the master adapt? We'll never know for sure, but it's worth pondering.
definitely. And that idea of adapting and engineering leads to our second, maybe more immediate final thought, which is about the financial engineering of this show.
Ah, yes. Back to our own little project.
We spent a lot of time breaking down the complex engineering behind STRC, and we really want to bring the same level of detailed analysis to you in a more visual format. We think video could make these concepts even clearer.
And as we mentioned, the key to doing that efficiently, without breaking the bank, is getting access to that tool, the Mosaic AI video editor. Again, that's at mosaic.so.
We're genuinely excited about it. Imagine feeding our YouTube audio link into Mosaic and having it automatically generate relevant visuals, B-roll, animations. Basically automating a huge part of the creative workload to produce high-quality videos consistently.
It sounds like a game changer for content creators like us. But, as we said, it requires resources. And the key to unlocking those resources for us is hitting that 1,000 subscriber milestone on whichever platform you're listening on.
So one last time, if you found this deep dive valuable, if understanding the 82.8% impairment threshold for STRC, or the mechanics of return of capital, or the Boglehead versus modern mix trade-offs was helpful, please take 10 seconds right now.
Hit that subscribe or follow button. And if you know anyone else who geeks out on this kind of financial detail, share the show with them.
Help us build this community, reach that 1K goal, and unlock the tools to make these deep dives even better with video. We really want to bring you video versions.
Every subscription genuinely helps us get closer.
Absolutely. Thanks so much for joining us. Until next time, keep searching.